Hello there. Welcome to episode 9 of 10-Minute Bookkeeping Series. We're almost at the finish line, and today we're tackling the final piece of the financial statement puzzle, the statement of cash flows. Get ready to learn what it is and how to create one using both direct and indirect methods. But that's not all. We'll also talk about how to close temporary accounts as we bid farewell to the accounting period. By the end of this episode, you'll have all the bookkeeping skills you need right at your fingertips. No time to waste, let's get started right away. For many people, cash is king. Why? Because every business needs cash to pay the bills, cover salaries, handle interest, and more. That's where the statement of cash flows comes in. It reveals how cash moves in and out during a specific period, helping people understand an entity's cash story. This statement has 4 key sections. First, we have the operating activities section. Here, we see how much cash the entity's everyday operations generated or used during that time. It's the cash engine of the entity. Next up is the investing activities section. This part deals with buying or selling long-term assets, giving us insights into how these moves affected the cash flow. Then we move to financing activities. This section tells us how much cash the entity raised from lenders and owners during the period. It illustrates where the entity got its financial support. When we tally up the cash flows from these 3 categories, we can see the total cash fluctuated during the period. Finally, we wrap it up with the cash balance section, showing the cash at the beginning and end of the period. Understanding these operating, investing, and financing activities is the roadmap to preparing a statement of cash flows. So let's hit the road straight away. There are 2 main ways to create a statement of cash flows, and one of them is called the direct method. Let me walk you through how it works. First, whenever we post a transaction in the cash account, we need to specify why the cash moves. For instance, is it money received from a customer? Have we paid for a new piece of equipment? Or the owners invested more? These whys are crucial. After labeling these cash flows, we group them based on their reasons. For example, cash received from customers falls under operating activities, while money spent on equipment is categorized as investing activities. If we get cash from owners, that's part of financing activities. The last step is to present the statement. Once we have these categorized cash flows, we can calculate how cash has changed during the period. Then, by finding the initial cash balance, we can put together the full statement of cash flows. Now let's talk about the indirect method, which is another way to create a statement of cash flows. The steps for the indirect method are quite similar to the direct method. We figure out why cash changed, put these reasons into categories, and then present them in the statement. The biggest difference between these 2 methods is how we look at these reasons. In the indirect method, we see changes in non-cash items as the causes of cash changes. This way of thinking stems from the magical accounting equation, which makes sure that the balance sheet always matches, no matter whether it's at the start or the end of an accounting period. So the changes in cash, plus changes in non-cash assets during the period, always align with changes in liabilities and equity during that same time. Do you remember this? Net income minus dividends equals changes in retained earnings. The net income details come from the income statement, and information about dividends can be found in the statement of equity. Up to this point, you can see how the indirect method unravels the connections between financial statements, making it a far more popular choice than the direct method. Now let's break down the specifics. When non-cash items increase, cash decreases. It's pretty straightforward. You need cash to buy other things. On the flip side, when non-cash items decrease, cash increases because you're selling non-cash assets to make more money. When liabilities and equity increase, cash goes up. It also makes sense. More liabilities means someone has lent money to the entity, and an increase in equity means owners have invested more, or the entity is making more money. In contrast, when liabilities and equity decrease, cash decreases. Fewer liabilities mean the entity is paying back debts. A decrease in equity means that owners have taken money out of the entity. Of course, these changes might not have an immediate effect on cash, but their ultimate impact on cash always follows these fundamental principles. For example, when inventory increases, it could be matched with an increase in accounts payable, not affecting cash account. When the account payable is settled, it leads to a decrease in cash. You might question what happens if the account payable isn't settled. In such cases, the liability grows, resulting in a positive effect on cash, magically countering the potential negative impact of inventory increase. Nevertheless, these actions consistently align with the fundamental principles we talked about just now. In summary, in the indirect method, an increase in non-cash assets results in less cash on hand, while an increase in liabilities and equity leads to more cash flowing in. Now, let's create a statement of cash flows for Able Company using the indirect method. We'll go through the process in simple steps. The first step is to find out the reasons behind cash changes. This initial step can be divided into two more manageable phases. Firstly, we calculate the changes in each non-cash item on the balance sheets. We also need to break down the changes in retained earnings into net income and dividends. Secondly, we determine how the changes in each non-cash item affect the cash. For instance, the accounts receivable increased. An increase in non-cash assets indicates a decrease in cash, and this means less cash. Here's another example. The accounts payable decreased, and less liability implies less cash, so this also means cash reduction. Now, consider the impacts of other non-cash items. Feel free to pause the video and make your predictions. Did you correctly assess the impacts of these changes? Now, let's move to step 2. We categorize cash changes based on their reasons. Adjustments involving current items such as accounts receivable and accounts payable, the consumption of long-term assets, and generating net income all fall under operating activities. Consequently, the associated cash changes are classified as cash flows from operating activities. Buying or selling long-term assets falls under investment activities, so the related cash changes are grouped into cash flow from investing activities. Raising money from lenders and shareholders is categorized as financing activities, while the distribution of dividends can be treated as either an operating or a financing activity. In our case, we classify it as a financing activity. As a result, the associated cash changes are categorized as cash flows from financing activities. The last step is to present the entire statement, just like this. In practice, we usually start with net income, because people are often curious about how net income can be transformed into cash earnings. All right, now let's move on to the last section. Once all the financial statements are prepared, it's time to bid farewell to the accounting period. This involves closing all the temporary accounts. So what exactly are these temporary accounts? They encompass the accounts for revenues, expenses, and dividends. Temporary accounts are called so because they gauge amounts over a specific accounting period, and at the very end of each period, their balances are reset to 0. This reset allows them to accurately measure amounts for the next period. Now, let's walk through the steps of closing accounts, using Able as an example. Firstly, we close any credit balances in revenue accounts to an account called Income Summary. This Income Summary account is also temporary, and we only use it during the closing process. For instance, if Able had a credit balance of $339,000 in sales revenue, we make this entry, and the balance in the sales revenue account becomes 0. Next, we close any debit balances in all expense accounts to the Income Summary. Here, I'll give you a moment to pause the video and close all the expense accounts for Able. All right, have you got all these closing entries? By making these entries, all the expense accounts are reset to 0. Okay, now it's time to close the balance in the Income Summary to retained earnings. At this point, the balance in the Income Summary matches the net income we calculated for the income statement. And we close the Income Summary just like this. Finally, we close any credit balance in the dividends account, as outlined here. This brings the balance in retained earnings to $151,000. aligning with the figure we calculated for the balance sheet. And there you have it, a clean slate to begin the next accounting period. For now, you've completed all the bookkeeping skills learning. Excellent job. It's amazing how far you've come. But don't hit the brakes just yet. Go finish the exercises to refine your skills. I'm sure you can achieve even more.